Hi there, it's Ron Gula from Gula Tech Adventures. Today we're going to continue our series on Venture Capital 101 with a brief discussion of different types of potential investors. Now, I am, of course, speaking about this as a cybersecurity investor. Started my career at the National Security Agency, co-founded with CEO of Tenable Network Security, which raised record amounts of venture capital. And my day job is running Gula Tech Adventures, where I regularly interact with other venture capital firms and companies raising money and trying to grow and protect the nation's cyberspace. So I asked ChatGPT to draw a bunch of pictures of rich venture capitalists. This is what they came up with. I've never really met anybody that looks like this in all my years doing this. They typically dress like this and are pretty chill and pretty relaxed. There's two types of potential investors out there that you should keep in mind. One is you can raise money from people, or two, you can raise money from organizations. And by organizations, I really mean businesses. Businesses basically created to invest, return a profit, guide those investments, and return a profit for their investors. People who invest, an angel investor might be somebody who invests maybe $50,000 when you're raising that money. Maybe if you were raising $500,000, you might need to talk to 10 angels to get your initial company going. You might actually speak to a high net worth individual who can write you a $500,000 check, perhaps multi-million-dollar checks. I talk about those kind of people a little bit later. If you're lucky enough to interact with somebody like that, that's great if you can get the conviction to have them invest in your company. But most of the time when people are investing in companies, you're raising money from your immediately circle of friends, people you know, perhaps a family member, perhaps you have a rich uncle, perhaps you're at the dentist one day, you describe your business and your dentist, has the ability to write you a check. I've heard hundreds of different stories of how the friends and family and seed round went. But you might also be introduced to somebody in your industry who takes a liking to what you're doing and invests a little bit of money and gives you guidance. Perhaps they don't even join the board. Perhaps they just kind of be there when you need them. And I've seen all different types of investors at this level on the personal side. But the vast majority of investing occurs from organizations. These are businesses that raise money from other potential investors so that they can invest in your company and return profit for their investors. There's all different types. Seed funds focus on early stage companies. Incubators and studios are a lot like seed funds or venture funds, except they bring you into their offices and surround you with advisors and other potential companies that they're incubating so you can learn together. A venture fund is your typical A-round lead where maybe a company originates an investment, maybe they write $3 million, $5 million check. Each different vertical out there has different amounts. In cyber, A-rounds when I started maybe 20 years ago were like a big $3 million round, $5 million round. I see A-rounds today in 2023. They could be $20 million. They could be $10 million or a little bit bigger. Typically an A-round is when you're close to a product market fit and people are willing to take a bet on your company so you can maybe get to your first $10 million in revenue, maybe your first $5 million in revenue. A growth fund is a company who only invests is a business who only invests in companies where they've got their product market fit, they know how to sell, and they know that if they take $10 million of raise or $30 million of raise, that they can turn it into maybe $100 million of revenue. Now, in all of these situations, you certainly would never want to raise $10 million to then make $1 million, right? You want to actually show growth and be able to prove that sort of thing. And that typifies a growth investor. And lastly, there's another type of investor called private equity that buys companies, controlling interest in companies, maybe companies before they go IPO, they buy stock in them, or maybe they buy companies where there's a problem with the management team, problem with the go-to-market, where they believe that owning the company and kind of rebuilding the management team, rebuilding the go-to-market might actually generate more value for the investors over time. Some private equity firms even specialize in roll-ups, where they'll buy maybe 2 or 3 companies who have maybe interesting technology but failed go-to-markets. Perhaps rolling them up and changing the go-to-market with the new management team can offer more opportunity for growth there. Now, Gula Tech Adventures, we're a family office. We operate sort of like a seed fund and a venture fund. We'll do different types of deals as things that fit our investment thesis. And there's a lot of bleed over with that. You'll see venture funds do seed funds. You'll see venture funds. They're really confident in a company. Maybe they'll lead the growth fund. There's a little bit of bleed in each of these things. It's never a hard and fast true of what deals they don't do and what deals they will do. Something that's universal across all of these funds, though, is there's this concept of carry. So if you're in the business of selling products, when you receive an investment from one of these funds, you are the product. And the way they make their money is if they invest $1 in you, that means they got that dollar from one of their investors. Well, how do people make money? Well, basically, if they can take that dollar and they give you enough advice and help you, and maybe someday you go IPO and that dollar is now worth $100. Well, the way it works is they'll give the original dollar back to the investor. They get that money back. And then the $99 of profit, they will keep a certain percentage of that. And that percentage is called a carry. So perhaps it's 20%. That's a very common rate in cyber. The fund will keep that 20%. And that other, I guess, 78, 79% goes back to the investor. So that's kind of what should be on your mind when you're raising money from these funds. How do you look in their eyes? How are you helping them, get a return for their investors? There's some things to be aware of, though. Most funds invest in multiple businesses. Now, if I'm a cyber investor, I try not to invest. If a company builds security widgets for one purpose, I try not to invest in other companies that do that same thing. That's clearly a conflict. It's kind of hard to then, go to a company, help that company with advice and maybe getting acquired, maybe helping acquire other companies without that conflict. So you have to keep that in mind. But by and far, almost every type of fund that's out there brings a lot more than money. They usually have teams of investors that can supplement maybe your HR processes, give you guidance when you're trying to hire people, maybe raise more money, maybe do introductions for potential M&A opportunities. And I really saw this happen a lot in the when COVID happened. COVID happened. A lot of companies had really closed down, work from home. It was very disruptive. Most funds that I worked with, really had their founders and protecting the companies and the employees of those companies as much as possible. And it's definitely interesting. Now, if you're sitting there, you're thinking, I'm just two people, I'm just one person, I'm thinking about raising someday, and you're intimidated. You feel like if you call on these venture capital organizations, you're like Dorothy going into the Emerald City, talking to the Great Wizard of Oz. The reality is that most of these people get pitches all the time, and it's not a problem to go in and do a pitch. And you're not going to, you're usually going to get feedback. Most of these venture capital funds were in your shoes at one point. They're going to give you some feedback. They're human. They're looking for an investment. Now, the answer might be no, that they want to invest in you. But almost always, these people are into it for capitalism, for the protection of America, for the land of opportunity and whatnot. But one thing I will close with, though, is that I have great respect for all the other venture capitalists in our industry, but we all tend to look at each other sometimes and go, why did you do that investment, or why didn't you do this one? And I'm often reminded of the parable in the Bible where the owner of the house, gave each of his 3 servants 10 talents, 10 gold pieces, if you will. They all did different things with those investments. And, the guy who owns the house there, he, kind of looked at each of these investments and the results they had, and he kind of rewarded people accordingly. This is what happens a lot in our industry. Why people do investments and why they're not, from their point of view, is very sound and very good balance of risk. But people who don't do it on every day, they might feel offended, like they didn't really get to raise, or the pitch didn't go as well, or they invested in somebody else who, our product is twice as fast as theirs and whatnot. So if you're out there raising, you're probably going to have to talk to more than one person, more than one organization to raise the money that you need if you're going there. I would just remind you to check out the videos I've done on the 5-slide pitch deck and the other videos we've done in this series here. And, part of life is learning how to convince people that what you're doing is a good thing and worthy of investment. And it's not any different with running a business. So having said that, I'm Ron Gula from Gula Tech Adventures. Thanks for watching the video today. And if you wanted to see more things like this, subscribe to the channel or visit us over at gula.tech. Have a great day.